You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this episode of the Tax Smart REI podcast. Today, we're going to be discussing a very important topic, and it's going to be why BRRRR, buy, rent, refinance, repeat, is the ultimate tax and wealth building strategy. You heard that right. It's not just about reducing taxes, it's about building wealth. That's why we're all in real estate to begin with, right? Not just to reduce our taxes, but to build our wealth. And that's exactly what we're going to be diving in today in just 1 minute. Hey, are you ready to maximize returns and eliminate busy work? Stessa is the number one rated accounting app for landlords designed to help you streamline operations and automate accounting so you can spend more time growing and optimizing your portfolio. That's why investors like you have moved on from QuickBooks and Excel to Stessa. The Stessa platform includes automated bookkeeping, a full suite of accounting reports, best-in-class tenant screening, a comprehensive tax package, a free online rent collection, high APY banking, and a top-rated mobile app, and much more. Investors using Stessa are reporting saving on average up to $4,000 and over 100 hours of valuable time every year. Get started with a free account today and set up your properties in just minutes. You can create a free account by going to www.stessa.com. Again, it's www.stessa.com to set up your free account and start managing your portfolio more effectively and with less effort today. All right, and we are back. So the first question probably everybody has here is, what is BRRRR, right? For everybody who's uninitiated, maybe never heard the term BRRRR before, it stands for buy, renovate, rent, refinance, repeat. All right, and this is typically used in the single family world. But the concept also applies to commercial and multifamily real estate, except it's typically called value add. It's not called BRRRR in that universe, but it's the same concept, just a different name. And it can be used with long-term rentals or short-term rentals. It makes no difference. Ryan, do you want to go through what BRRRR is?
Yeah. And so even just BRRRR, right? You said it: buy, renovate, rent, refinance, repeat. Another part of that too, most people are probably thinking, I buy a property that's already existing and then I renovate that, make some updates, right? Maybe it hasn't been updated in a few decades. This could also be like you buy a piece of land and build, right? On top of that, just a new construction, new development. That would obviously be included in here. But the point is we're adding value, right? And you might spend $100,000 on the cost, but now you've increased all of that value on the property by $200,000, right? So now we've got this kind of $100,000 in my little theoretical example that now we've added wealth and got some margin or some profit here that's going on. So really that's part of the renovation part. We're just simply adding value. And like you said, that's different phrasing a little bit with multifamily and whatnot, but then renting it out and actually getting it stabilized. So now that we've increased the value, we've got new, say, cabinets, countertops, appliances, light fixtures. This thing looks really good. New coat of paint, all these things. Now, maybe instead of getting $1,000 a month for rent, now we can maybe get $1,500 a month in rent, because now we've really increased who's going to be there, the clientele, and the cost or the rent that they're going to be willing to pay, because great, this looks awesome. Then what we could do, we've got this thing good to go. Part of our option now with the refinance is that you have an appraiser come through and they're like, hey, wow, this thing looks really good. You might have bought it for $500,000. You put in $100,000, so you're in for $6,000. But now the appraiser says this is really worth $7,000, right? $700,000. Okay, great. Now we do this kind of refinance and they say we're going to appraise it at $7,000. Well, based on whatever the ratio they're going to do for loan to value, you might be able to take out a bunch of your cash in, right? So now we're cashing out the cash out refinance. And now depending on the numbers, you might have nothing in that investment. And we are not going to talk about, infinite returns, anything like that on this episode, but you could come to a position where really you've got no money in anymore of your initial down payment or even the cost of those renovations. So now we've got all this money back out, and hey, what are you going to do? Hopefully go repeat, right? And that's the last R. So now you're going to go do this again. You're going to take that money you just put into this one. You've still got the property, right? We haven't sold it in my example. And now we're simply going to go buy another property, a new down payment, and repeat the process. So hopefully that was like a really simple example of kind of how that works. But anything you'd add in, Tom?
No, I think you hit the nail on the head. And what we got to look at here first, right? We're going to look at two things right now. We're going to look at how BRRRR helps you build wealth, okay? And Ryan kind of alluded to it a bit right there. And also why it's so tax efficient and why it just as a combination, the strategy is just like so powerful, all right? So how does BRRRR help you build wealth? Well, first thing it does, like Ryan was mentioning, is when you buy a property, you're going to increase the property's value through your renovations, through your value add process. And as you do that, your equity in the property is going to increase. When your equity in the property increases, so does your net worth, pushing up your wealth. All right. The second thing it allows you to do is pull out the cash tax-free using the cash out refinance to acquire more properties, and you could build a substantial portfolio doing this because you don't have to sell your properties. You just raise the value, you do the cash out refi, and you take the money and you go and plow it right back into the process. So you just go buy another property. Before we jump into why BRRRR is so tax efficient, do you have any comments, Ryan, on why it's so good from a wealth building perspective?
Yeah. So one thing, as far as the property's value increasing, there has been from politicians talk about taxing unrealized gains, right? So you got the Elon Musks, the Jeff Bezos of the world, where they've got all this stocks and they're talking about, hey, we're going to basically tax you on the unrealized, even though you haven't sold it, right? We're going to tax you on the unrealized capital gains and say, hey, you owe us tax on that, right? That's not happening with real estate at this point. And that's obviously not happening so far with stocks. But the point is that although you've increased that value, we're not paying tax on that, right? So that's good. You've got this kind of no taxable event, even though you have increased the value. And appraiser says, hey, it's way up here now. Okay, so that's good. No taxable event. And we've built wealth. But the second part is the cash out refinance. I just wanted to say too, a really common question I get from clients and other people I know is, well, can I take out money even just from my checking account? Right? And is that going to be a taxable event? The answer is no. Okay. Especially if we're just talking LLCs or sole proprietorships and whatever. S Corps and C Corps might be a different thing. But for most real estate investors, we're just looking at LLCs. So if we're looking at a cash out refinance, it's also not a taxable event for us. I know you're going to talk about that a little bit more as we get through this, but I just wanted to make a comment on that too. Just because we're taking cash out or the property is increased in value, neither one of those things are a taxable event. So yeah, talk to us about more about the BRRRR tax efficiency.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Hall CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help, but for now, we'll dive right back into today's episode. All right, cool. So moving right along into why BRRRR is so tax efficient. So we discussed episode 270 of the show, how simply investing in rental real estate can reduce your effective tax rate. And that's powerful in and of itself because earned income, so income you have from a job or a business, can be taxed at very high rates if you're a high income earner, 37% at the federal level, plus self-employment tax up to 15.3%. And also then you add state tax onto that, and high income earners can easily be paying between 40 to 50% of their earnings in taxes. However, with rental real estate, you can shelter your rental income from tax, which means you could be telling the IRS that you're losing money meanwhile you're generating positive cash flow, or simply you're putting money into your pockets and you're telling the IRS, hey, I didn't make any money. So they're not taxing you on it, right? Because you're reporting a loss. So that's the first way that BRRRR is so tax efficient. You're building this portfolio that eventually will cash flow for you, and you could shelter that cash flow from tax, something very difficult to do with earned income. All right. Now, the second reason why this is so tax efficient is because when you do need to pull out cash, like we were talking about before, you could pull out cash by getting a cash out refinance, and that's tax free, meaning you do not need to sell your property. You do not need to pay capital gains tax to get the money out. You can keep your property, take the money out, and go buy another one. Now, having said that, there are some reasons why you may want to exit a property at some point despite this. All right. Maybe the market that you're investing in is not good. Maybe a major employer left and it's just not a good market anymore. It's time to exit. Maybe there's just something functionally wrong with the property and you don't want to deal with it. Or maybe there's any other number of reasons. Maybe you want to buy a bigger property, right? Maybe you're eyeing a bigger property and you realize, hey, I can't get enough cash out refinance from my properties to do this. I actually need to sell one, right? And the good news is you can actually sell your properties tax efficiently too.
I just want to mention, as we're talking about, do we do a refinance? Do we do a sale of a property? Episode 273, Brandon was actually talking to Chris Lopez, and they were talking about return on equity. So really good podcast there. I feel like we've actually referenced a couple podcasts now for other people to kind of tie into this conversation here. But that's a really good one. And the thing I'll just note before I move into the next part is that we're in an interesting market with interest rates, right? Where interest rates are still high. And so refinancing now, you might be thinking, well, I've got a lot of equity in said property from a few years ago, but my interest rate is only at like 3-4%. Well, if I go refinance now, well, now I'm going to be at like maybe 7, maybe 8%, right? Kind of depending on your whatever you're doing. So I know refinancing today, right in this moment, for what we've been looking at historically, you might be thinking, hey, that's a tough thing. So then you might be looking at, yes, doing an actual sale. But here's the thing, right? As we move into the next part, what is really a sale, right? And so we would then be considering, do you want to do a normal sale where it's you actually close on the property, you take the proceeds and go do whatever, right? Put it into savings, pay off debt, or buy another property, right? Whatever you're going to do. But in order for this to be even more tax efficient, and this just, in my mind, adds into the very valuable strategy already in BRRRR, which is to do something like a 1031 exchange, right? Now, yes, we're kind of selling this property and kind of increasing whatever it is to a better property or higher cash flow or whatever it is, great. But at the end of the day, if we're doing a successful 1031 exchange, moving all the proceeds in, we've met all the requirements, great. Now we don't actually have a sale as a taxable event. Now we're just upgrading our property, and now we've got this kind of swap that we're doing, right? So not a sale, no taxable event. And if we can continue to do that until we quote unquote drop, okay? This is the swap till you drop strategy, otherwise known as defer, 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 die, okay? Basically now we are in a very efficient tax strategy from a very long-term perspective. And that's what I think Tom and I are really trying to emphasize is that, and we'll get to something here in a second, but really we're thinking BRRRR is really good, fantastic. That's like right up front, right? You continue to do BRRRRs going forward, but then what happens when you do want to have that sell? Hey, we're looking at a 1031 exchange and continuing to 1031 exchange until we pass. Why? What's with the passing or the dropping, right? The dropping is because we get a step up in basis, okay? So we pass away with maybe a few rental properties. Maybe our basis in this is say $1 million, right? But maybe the properties are valued at 2, okay? If we sold it the day before we passed away, we would be paying tax on $1 million of income, okay? But when we give it to our kids, they're going to actually receive it at a step up in basis. That's what we're talking about. And their cost basis is now going to be $2 million in my example. So now all of that tax is now been eliminated because they got a step up. So if they sell it the next day from the day that they received it, now they're paying zero tax, okay? We're kind of assuming their cost is essentially the same as fair market value, what they truly could sell it at, okay? So it's a very efficient strategy from the beginning, and even most efficient, I would say, from a building wealth strategy till the very, very end. So that's kind of the 1031 exchange or the swap till we drop sort of concept there. Any comments from you, Tom?
Yeah, absolutely. I just want to double down what you said about the long-term view. Like when you're in real estate, this isn't like a one and done game. This isn't like a 1-year thing. It isn't like a 2 or 3 year thing. If you really want to succeed, if you really want to build wealth, you have to look at this as a lifetime game. Like you're in real estate for life. And it's hard to think long-term, right? It's even hard to think sometimes, a few months down the line, but you got to think long-term about what you want, right? And if you're in this game for the long haul and you use strategies like BRRRR, you combine them with the 1031 exchange, you can build an incredible amount of wealth, right? In a very tax efficient way. Look, we have a lot of clients who've used this strategy and use this strategy only, like BRRRR and then 1031 exchanging, and have made incredible amounts of wealth. I mean, one of our partners, Taylor, here at the firm, built a $30 million portfolio over the last 10 years using BRRRR and 1031 exchanges. So this is proven to work. And if you want to check it out, Taylor spoke about it. I was looking for the episode number. I can't find it. You're going to have to scroll through the feed, but he gave his story here on the show like 3 or 4 times. So if you just scroll down the feed, you'll be able to find that episode with Taylor Brugner where he breaks down how he did this, right? And he also talked about it, if I'm not mistaken, at the Tax and Legal Summit, where he also shared a part of his story as well. So that's something you're going to want to check out. But the last thing I'll say here on tax efficiency on the exit is that the 1031 exchange is a very popular tool, popular for good reason. It's very powerful. You could sell your property and defer the tax in the future. You could continue doing that over and over during your lifetime. However, that's not the only exit strategy. There's other exit strategies out there. Ryan and I covered a bunch of them on episode 266, if I'm not mistaken, 7 tax efficient exit strategies to destroy your capital gains tax. So if you do want to check out the rest of the strategies that you can use to exit a property in a very tax efficient manner, I'd encourage you to check out that episode. However, like we said, you got to take the long-term view on this stuff. Now, one last thing before we part today. One last thing. First, I want to summarize why this is powerful, and then we'll wrap up with the last segment, okay? So again, we covered that use the BRRRR strategy. So you buy a property that needs work or you can otherwise add value. You renovate it. You increase the value. Via increasing the value, you're increasing your equity in the property and your net worth. Then you can go use a cash out refinance, which is tax-free, to pull money out without selling. So you don't have to incur capital gains tax, okay? And you could take that money and go buy another property while continuing to build your portfolio and keep doing this over and over and over again, right? And then if you do have to sell a property, or when it does come time to sell a property, you can use a 1031 exchange or one of a number of other exit strategies to exit in a very tax efficient way. All right. And again, like I said before, we've seen clients build massive portfolios doing this. One of our partners have done it here at the firm. But there's one last thing to discuss, and that is the icing on the cake. And I want to be very clear what this is. This is the icing on the cake. This is not the cake we're talking about. Ready? It's going to be a big one, right? It's going to be a big surprise what I'm about to say right now. Ready? Okay. It's going to be the real estate professional status and the short-term rental loophole, right? If you could stack these strategies on top of this, it's even more powerful. But again, it is just the icing.
Yeah, it should always be seen as that. And when people listen to our podcast, they're probably like, but this is all you guys preach, right? Well, that's because it's taxes, right? We're talking about taxes. And so this is a massive tax strategy. But we have been trying to, especially the last several months, kind of like rein people back, because we've heard and we've seen, people just get into this real estate stuff because they're just looking for tax savings. Okay. We need to more broadly be like, this is an investment, an asset class that I want to own long term, right? That's keyword, long term. And then we've talked about that on our episode here. But at the end of the day, yes, reps, real estate professional status, the short term rental strategy, loophole, whatever we're going to call it, that is now when you buy. Right now, we can actually take that and actually get tax savings. And maybe, Tom, you and I need to come up with some catchy little phrase of something tax savings or whatever to add into BRRRR, and we can market the heck out of that. But at the end of the day, that's really what we're trying to do. Yeah, you've bought a property. Great. You've got a new asset. If you've got a new asset, you've got new depreciation, right? So once you are doing that refi on the back end of a BRRRR, if you're taking that money out, you still got the property. So you're not doing depreciation recapture if you don't sell that property, right? So now we've got this new money. We go buy another property. Hey, new asset, new depreciation means new potential losses. So there is obviously a tax aspect into this. And I'm glad we've kind of tied this in at the end intentionally. But absolutely, like this is more tax, benefit on the end. And Tom, just to fill in, I'll let you go next. But I did find Taylor's episode. It was 221 for those who want to go listen to Taylor's episode. But any other comments from you?
No. Thanks for finding that episode, because it is a good episode. It's always a good episode when Taylor comes on the show. So definitely check that out. But like you said, this is just the icing on the cake. You got to take the long-term view. And at the end of the day, even if you can't use reps, even if you can't use the short-term rental loophole strategy, whatever, you can build massive wealth with real estate in a very tax-efficient way. All right. And look, a lot of investors out there are not real estate professionals, right? A lot of them are not using the short rental loophole. Look, you want to know something very interesting that I don't think people talk about? There's an entire world of real estate investors that you never hear from. They're not at Bigger Pockets events. They're not at these conferences. Like, I know this one family that owns buildings in New York. This family they own like 2 buildings in New York, and they're set for generations, right? Because they own 2 buildings. They're not real estate professionals. They have other assets, right? Or other businesses that they're running. I know this to be true because the group I'm talking to, I recruited somebody for them. So not mentioning any names, but this is back in the day. But that family's set because they bought real estate, they held it, right? And then they passed it down to their heirs. And then now their heirs have it, and it's continuing to be a cash cow for them for generations. So again, without the real estate professional status. So I just want people to start just shifting a little bit. Hey, this is a long-term thing. I could get in this for life. I could build a lot of wealth. I could do it tax efficiently. And I don't need reps. If you could get reps, great, fantastic. It's awesome. It's amazing. But if it's not in the cards for you, don't discount real estate. It's still here for you. That's all I got on this, Ryan. Any last words?
Awesome. Nope. I think we covered it.
All right, cool. So as always, we are bringing on new clients. If you are looking for a new CPA, you can head on over to www.therealestatecpa.com/podcast and fill out the brief form. We'd love to learn more about your situation and how we can help. And also, if you're a tax pro listening to this, a CPA, EA, and you're looking to make a switch, we are hiring. So go on over to www.therealestatecpa.com/careers, fill out a job application for the job that most aligns with what you're looking to do. And we love to learn more about you and how we can help. And that's all for today. And we'll catch you on next week's episode of the Tax Smart REI podcast. All right, wait a second. We're not finished yet. After the show ended, Ryan and I were talking about, could we make a new acronym to add in this tax efficiency into BRRRR, right? And Ryan came up with BRRRR, right? So it'd be buy, losses, rent, refinance, rehab, repeat. It just adds the losses into there because you're basically, with the depreciation, you're generating losses that are covering your rental income from tax, which we talked about during the episode. And then we did some more brainstorming, and the other one we came up with was BRRRT. All right, so it's buy, rent, rehab, refinance, repeat, tax optimization. All right. And both of them are interesting titles. Ryan, what do you think of these?
I'm at this point leaning towards BERT, and ChatGPT seems to also think that BERT might be a top choice. So I'll be curious to see what other people think about it. But I think the difficulty, like you and I were talking, is it's not a vowel. Right, AEIOU. So it, like bar would have been nice. We've talked about bar, right? And kind of got that talked about several years ago. BRRRR, like if we could put in an E, and maybe we could. Yeah, blur seems to have some. Nothing has like negative connotation. I think of BERT. I think of like guy's name sort of thing, and blur being like, oh, that was a blur. Like it went by fast, or it was kind of chaotic, and I couldn't kind of keep track of everything. So I think either one's fine, but I would love to hear from other people, our audience, people listening, kind of what they think. So what do you think?
Yeah, absolutely. We want to hear from you. What should it be? Should it be BRRRR or should it be BERT? All right. So if you want to drop us a line, I'm going to go ahead before this episode releases. I'm going to post a comment or post a post rather in our Facebook community, the Tax Smart REI Facebook community. And then everybody can go ahead. I'll put a poll. And when this episode releases, you can go vote on the poll and you can let us know what you think, BRRRR or BERT. All right. And you could join the Tax Smart REI Facebook group if you're not already a part of it by going to www.taxsmartinvestors.com/Facebook. You could join the group today. Let us know what you think. BRRRR versus BERT. Anything else before we wrap up?
Yeah. BRRRR versus BERT. Correct?
Yeah. Can I say something else?
I thought you said blurt. Like you had both of them in there.
That's another one that came up. Yeah. So it's BRRRR versus BERT. All right. So let us know what you think. Again, www.taxsmartinvestors.com/Facebook. We'll see you in the group. And that's it for today. We're really done. We'll see you on the next week's episode of Tax Smart REI Podcast.